Greetings from all of us here at Wespath. Thank you for joining us today. And thank you to all of our Wespath clients. We truly value our partnerships with you and are honored to help support your mission. My name is Joe Halwax, Managing Director of Wespath's Institutional Investment Services team. I'm here at Wespath's office in Glenview, Illinois, bringing you our third quarter 2023 Wespath update. The year has flown by and is now 3 quarters over. We've been talking about the same themes for much of the year: resiliency throughout the economy and a mixed bag for financial markets. Let's start with economic data. Growth has continued to come in higher than estimates, but so has inflation. GDP growth is estimated at 5% for Q3. So for now at least, we're seeing the soft landing for the economy. Inflation was 9% just 15 months ago, bottoming in June of 2023, but is now ticking back up to levels near 4%. So while growth is resilient and beating expectations, inflation is also. For the markets, stocks enjoyed a strong first half of the year. And while the third quarter saw some contraction, they're still up double digits. But digging deeper, nearly all of those gains are just from a handful of stocks, which we will discuss further. Meanwhile, bonds are now in year 3 of losses, the longest trend on record, and returns are now negative for the year. A mixed bag for the markets indeed. I'll offer more on these themes in a market update shortly. First, let's start with the latest out of Wespath. My colleague Evan Witkowski wrote a great blog on current factors impacting nonprofit income. Evan sits on the board of a Methodist retirement home and brings that experience to the piece. Also, Karen wrote a piece on values-aligned investing. In this blog, she highlights John Wesley's 3 simple rules: do no harm, do good, stay in love with God, and how nonprofits can align their portfolios with his teachings. As for an organizational update, Wespath is excited to have our new Deputy Chief Investment Officer, Johara Farhadieh, the successor to Dave Zellner, who plans to retire next summer. We're excited to have Johara join Wespath and look forward to having her meet our clients. As usual, I will be talking to Dave about the current state of the global economy later in this webinar. We will, of course, be talking about the recession that just quite hasn't happened yet. Karen will also join to review the performance of our funds, and Sylvia Poniecki will chat with me about our impact investment program. But let's start with a bit of a get-to-know-you conversation with Johara. Johara, welcome to the third quarter Wespath webinar. This is a chair that you're going to become very familiar with.
Thank you.
So Johara recently joined us as our Deputy Chief Investment Officer, and she'll be taking over as Chief Investment Officer for Dave Zellner when he retires in summer of 2024. So we're excited to have you here. We're excited to have our participants and our institutional clients meet you. So prior to joining Wespath, you were the Executive Director and the Chief Investment Officer for the Illinois State Board of Investments, or ISB. And there you managed over $24 billion in defined benefit contributions and also $5 billion in defined contribution assets. So that's a really big job.
I'm excited to be here. Thank you, Joe.
So you worked at ISB for 16 years in various roles and had a great deal of success there. What about Wespath did you find intriguing or appealing, and how did your previous work prepare you for your new role here?
What did I find appealing about Wespath, Joe? I gotta tell you, the number one thing was the people. Everybody I met that was affiliated with Wespath or the employees here, I think we had a shared value, and honestly, everyone's just kind, and kindness goes a long way. The second thing that drew me is the mission. It's always been important to me as an investor to be able to incorporate some aspect of doing good with the money, and as we manage billions of dollars, we play an important role to ensure that we're making money on that money for those beneficiaries and participants of the plan, but also doing it in a way that can affect change and do great work overall in the world. So I knew Wespath was doing that, and so to be able to combine both is just a beautiful thing.
And I think the longer you're here, you'll start to learn about some of our clients' missions, and that's always something that's really powerful when you hear those actual stories. So during your tenure, the board's private equity portfolio had the top-ranked performance amongst public pension funds for several years in a row in private markets. What was your approach to private investments, and why do you think it was so successful?
I am really proud of the team at ISB. We worked really hard to ensure that we had access to the best managers out there. And so kudos to the team there. In terms of the success we had in private markets, I think we could apply it overall to the entire portfolio. And I think it starts with ensuring accountability and ownership. And so empowering those that make certain decisions has been very critical to make sure that they're able to make those decisions, but then also, holding them accountable to those decisions. I would also say there is a healthy sort of sense of competition. What we do, it's numbers based, it's benchmarked, and so numbers don't lie. So I think there's always a healthy competition within like the investment team and partners that we work with. So I think that's pretty critical, and also just casting a wider net when it comes to access to managers and ensuring that we build relationships with those top tier managers, and not sort of go to the same network that
forever and ever.
Exactly.
Thinking about when you resigned, they published a very flattering statement, and I'm going to read it. They said, "You steadfastly championed diversity, equity, and inclusion while exceeding investment return objectives." So what DEI initiatives did you champion, and how did they help performance?
So I think it starts from the top in terms of DE&I. So I made it very clear that this was an important initiative for us, and it was part of our mission is to ensure that we were inclusive. And as I mentioned earlier, casting a wider net, I mean, that means being inclusive of all managers. And how do you do that? Again, is being intentional. We went to a lot of networking events, conferences that we knew would be more inclusive of smaller, diverse managers. And so it was important to us to be able to prove that accessing top tier managers and being inclusive was going to truly generate returns. So that private equity portfolio you mentioned earlier, Joe, it did rank number one in the country against our peers. But the more significant piece of that is 25% of it, approximately 25%, was committed to minority and women-owned private equity fund managers. So we were able to prove that in being more inclusive and diverse, that we're truly accessing the best managers out there.
No, thank you for that. And about your background, tell us about your background and your upbringing and how that shaped you into the kind of investor you are today.
So a little bit in terms of my background, I studied at DePaul University. I went back and got my MBA there. But I would tell you the background that probably influenced me mostly is more of my personal upbringing. I was raised by a very smart, strong, supportive mother. And I think we've gone through some hardships and challenges in life. And I think they've only made me more resilient, patient, and I can apply that sort of mindset as an investor. And so we've all gone through challenging times, living through the global financial crisis, the pandemic. I think it was important as an investor, as a leader, to stay calm, to understand what was going on in the markets, understand how it was impacting the portfolio at large, and then being able to effectively communicate it. I think going through those sort of significant challenges in my personal life only makes it really easy to be able to translate and handle difficult situations in my professional life.
Carrying from personal to professional. Yeah.
Yes.
And then when did you discover you had a passion for investments? Were you born reading Warren Buffett when you were 5 years old? Did you discover in college? Or when did you discover this knack and desire to be an institutional investor?
Yeah, I was definitely not born reading Warren Buffett books by any means. I was more interested in like the Babysitters Club. I don't even know if that is around anymore. But I would tell you the first moment that I started to have an interest in investing was around 18 years old. I worked at the Jewel starting at 15 years old, but when I turned 18, I was able to open up a 401k. And at that time, I remember there was money going out of my paycheck for union dues. And at that time, you don't fully understand, what was going on there. But then I was instructed by someone to put money away in my 401k.
Great advice.
And I didn't really understand at the time, but if money was going, I really did want to understand where it was going to. So that's where I started to have an interest in it. And then it got solidified in college. So I actually went to school to be a pediatrician. And my upbringing, it was
pretty similar to Chief Investment Officer.
Yes, well, patients, again, children. But in my family, you were raised either think of being a doctor, lawyer, engineer type thing. And so I went to school to be a pediatrician. I took a couple biology courses, and then organic chemistry really made me second guess why I was there.
Thank you to Paul Organic Chemistry.
So I didn't want to upset my mom. So I secretly applied to the College of Commerce. And the minute I entered that school and started taking statistics and other classes and finance courses, it was coming to me so naturally. And I got so excited about it all that I finally, a few years in, I had, it was about not my senior year, but probably closer to the end of my junior year, I told my mom that I'm making a career change. And so it was more in college that I solidified it. And then I think just, again, being able to mix mission with investing is really when it all took off for me, because it's just so important with the industry we're in to have that sort of mindset.
Yeah, that's some really great background. So before we're going to wrap this up with a couple rapid fire questions, but is there anything else you'd like the audience to know about your approach to investing or managing a pension fund?
Yeah, I think for me, in my many years of experience as a CIO, I would tell you that it's important for us to evolve. Information changes, and so I think it's important for us to analyze new information and reassess decisions that were made. And I'm not saying that this needs to be done on a regular basis, right, and that, not to be strategic, but I think it's important for us to really look at the environment we're in and what impact that will have, and to take decisions that were made 5-10 years ago and perhaps revisit them. And for example, we had a large portfolio at ISB, and it was a really great idea, I would say, 8 years ago. Today, I don't know that it's that great of an idea, and it's important for us CIOs to sort of admit to being able to go back on a decision, especially as information changes. So
does it make sense today that it made sense 8 years ago?
Exactly. So I would say that would be something that I try to stick to, and I think is really important as a chief investment officer.
Well, thank you for that. Now we get to have some fun. So we're going to do a little bit of a lightning round.
We or you get to have some fun.
We're all going to have some fun.
Let's see.
All right. So what's your biggest motivation?
Being able to affect change. So, anything that I do, I try to hope to make better, or, so it's motivating. It's exciting to be able to make a difference.
All right, and coming off of 3 days this week at a conference, how are you doing figuring out all the acronyms of Methodism?
It's tough. There's a lot. It's tough. Yeah, I would probably tell you I'm not doing great, but better than every day. I'm getting better.
It'll take a few months.
Yeah.
All right, what does a perfect day off look like?
Perfect day off would probably be a day that no one's melting down, including, I have 3 kids, I should probably note that. And I would say a day where no one's really melting down, including myself and my husband. Yeah.
With 3 kids, that probably doesn't happen all that often, but that's why it's a perfect day, right?
Yeah.
All right, would you rather eat out or cook at home?
That's tough. I would say I appreciate both because I love food. I have a passion for food. My husband's a great cook, so I don't mind eating at home, but I love trying out new restaurants. And something exciting is that this investment team, I think, has a passion for food.
We have a few.
Yeah, and on my first day in the office, Fred had baked a French apple cake. So this is just all, everyone's speaking my language here.
It's coming together.
Yes.
So you mentioned that you have 3 young children that keeps you very busy, but are there any hobbies or passions that you have outside of chasing after them?
What is a hobby? Just kidding. No, I do actually. So I'm passionate about being a mom and being very present in my kids' life. So I am a room mom. And I think that is somewhat of a hobby. It takes some talent to be a room mom. So,
and patience.
Yeah, and patience. So I do that. And then I also sit on the investment committee at their school. Again, mixing my professional skill set, but also being there for my kids. And then also part of La Rabida Children's Hospital Board.
Fantastic.
So a lot of children-related stuff.
Children hobbies.
Yes.
Well, that's what we have, Johara. It's fantastic. Thank you for sitting down with us. We're really thrilled that our institutional clients and our participants can meet you, and we look forward to having you in this chair a lot more in the future.
Me too. Thank you for having me.
Inflation has been the focus for over 2 years now, so we may as well start our market update with a look at that. As you likely know, inflation has been cooling since the summer of 2022, but for now, it looks to have bottomed at 3% 3 months ago in June. Currently, inflation is tracking near 4%. Remember, the Fed targets 2%, so we are double that. The data is one of the drivers of interest rates. Towards the end of the third quarter, yields moved sharply higher, with the 10-year U.S. Treasury yield pushing from 3.95% to 4.55%. The 10-year has continued to move higher to 4.85% in early October. These current levels are 16-year highs, levels not seen since before the Great Financial Crisis. As yields have moved higher, borrowing costs have also moved higher. Think about things like home mortgages and auto loans. These are at double the rates paid just 2 years ago. For example, a 30-year mortgage was near 3% just 20 months ago in January of 2022, and now it's near 8%. You can see from this chart that the 10-year yield has been tracking inflation. And from a trend perspective, we have really broken out of a long-term downtrend in yields. Interestingly, if you look at this chart, you can see the break higher in the 10-year yield, which is the blue line. Since 1958, the longer-term average for the 10-year is 5.76%, and inflation using CPI is 3.68%. We may be seeing a mean reversion to more historical levels of inflation and yields. By that, I mean several years of higher rates and inflation than we have seen in the past 15 years. This will have implications for asset markets. While economic data has been strong, high yields are starting to cause some pain that is worth watching. New home sales are softening, with August total down 8.7% from July. The Conference Board's consumer confidence gauge fell to 103 in September, down from 108.7 in August. While the economy has been resilient, historically rate hikes will slow an economy down, especially the size and the speed we've seen this time, 5% in 18 months. The Fed indicated there may be 1 or 2 rate hikes from the current 5.25 to 5.5% range, also implying a higher for longer stance, meaning they may stop hiking, but it will take some time and much lower inflation before they actually start cutting rates. Remember, I said earlier that the Fed targets 2% inflation, and we are near 4%. One question we frequently receive is why are growth and inflation so high with the Fed aggressively hiking rates? One theme is fiscal policy, or government spending. The U.S. had a $2 trillion deficit in 2022 and is set for $1.5 trillion in 2023. As you can see in this chart, that doesn't just sound like a lot of money. It is a lot of money when compared to GDP. For some perspective, we haven't seen debt to GDP like this since the World War II era. This has gone a long way to counteract rate hikes in terms of economic activity. We now have a new war in the Middle East. For markets, the global energy supply is even now more fragile and will continue to support higher for longer inflation. For stocks and bonds, historically these types of conflicts have a limited impact as long as the conflict remains local. Should this escalate, it would be a sharp headwind for risk assets. Now let's take a look at the market performance in the third quarter, starting with equities. The S&P 500 was down 3.3% in Q3, consolidating after a strong start to 2023, bringing its year-to-date gains to 13%. The Russell 2000 index of small-cap stocks was down 5% on the quarter, widening its year-to-date gap against the S&P 500 to 11%. Large-cap stocks have continued to outperform small and largely from growth-type companies. We noted last quarter that in the U.S., we are seeing extremely high levels of concentration, meaning roughly 70% of the S&P 500 return is driven by a small number of stocks. These stocks were down in the third quarter, but continue to have outsized gains on the year. Let's take a closer look at this concentration now. Many of these stocks are considered to benefit with the growth of artificial intelligence and technology themes. These tech companies have demonstrated solid earnings growth, but those earnings recently have not kept pace with their returns. As such, the earnings multiples reflected in their stock prices have expanded significantly. The forward price-to-earnings ratio of the 10 largest stocks now sits at 25.9 times, which is more than 45% higher than the multiple of 17.8 times for the overall market. Looking at the graph on the left, you can see below that the top 10 stocks are near 32% of the S&P 500, and this has accelerated from levels near 23 in 2020. Looking at the graph on the right, the earnings of those same top 10 stocks as a percent of the broad earnings of the index, this has fallen from over 30% in 2022 to 21% now. This does not support the idea that this trend of sharp concentration will continue indefinitely. Now, looking at international stocks, global economies and their stock markets were also showing mixed trends in Q3. International stocks measured by the MSCI EAFE index were down by 4.1% on the quarter, lowering their year-to-date gains to 7%. China remains a disappointment amid paltry economic growth and continued uncertainty in the real estate market. Approximately 70% of household wealth in the country is tied to the now uncertain value of homes. Chinese stocks, measured by the MSCI China A shares, were down 3.5% on the quarter and 9.7% for the year. On the other hand, Japanese stocks were up 2.2% on the quarter and are higher by 24% on the year. These are now at a 33-year high. This can be attributed to the more accommodative monetary policy adopted by the Bank of Japan in recent years. Fewer rate hikes and balance sheet reduction have resulted in a boon for the Japanese economy and the markets. Meanwhile, Europe continues to experience anemic growth, and their equity markets continue to underperform those of the US. We mentioned the extensive fiscal support and the huge deficits the US is running. The majority of Europe and the developed world is not growing debt at this pace. Should the spigot of fiscal support close in the US, we'd be primed for some international outperformance. Shifting gears a bit, before we talk about bond returns, let's quickly focus on the US yield curve. Specifically, take a look at the right half of this chart. This is a visual representation and helps explain another quarter of poor bond performance. The blue line is June 30th and the green line is September 30th. You can see from the right side of the chart a sharp rise in the green line, which shows how much bond yields have risen in the longer dated bonds. Notice the yield curve became less inverted, meaning the longer dated yields are rising to levels closer to shorter dated yields. Historically, this has been a signal for weaker economic growth over the next several quarters. The US bond market experienced a 3.2% decline in Q3 as yields rose. Remember, when yields rise, bond prices fall. On the year, the Bloomberg US Aggregate Index is down 1.2%. Unless there is a significant fourth quarter rally, the major bond indexes are on track for their third consecutive year of declines, a trend that's pretty much unprecedented. We've already touched on the stronger economic data that's helped drive bond yields higher. Higher for longer should remain a theme until inflation is closer to the Fed's 2% target. Lastly, as the US continues to run multi-trillion-dollar budget deficits, the funding that comes from issuing more bonds to take that new supply, yields sometimes need to be higher. That being said, looking at the past 10 years, bond yields have never been more attractive. Looking at this chart, the blue diamond represents the yield to worst, the lowest possible return of a bond that operates within its contract without defaulting. These are either at the high or near the high for the past 10 years, meaning bonds look cheap versus the past 10 years. One might say that these assets are finally putting the income back in fixed income. Given these valuations and leaning into the history of bond market cycles, we continue to think bond markets will remain an integral part of a balanced portfolio. I'm joined by my colleague Karen Manczko, who will provide an update on the Wespath Fund's performance. Karen, thank you for being here.
Thanks, Joe, and greetings everyone from Glenview, Illinois.
I mentioned earlier that the economy continues to show resilience, but with some weak points showing, specifically with the spike in the long end of the yield curve. The stock and bond markets saw negative returns on the quarter. With this said, Wespath funds were not immune, correct?
That's right. Our equity funds had a strong first half of 2023, but followed their benchmarks lower for the third quarter. U.S. equities were lower by 3.3% for the quarter, but fortunately, they're still up 13% for the year. International equities were down 4% and are now up 7% for the year.
So looking closer at bonds, while the data has been stronger, we've seen what may be considered cracks and bonds sold off at the end of the quarter.
That's right, Joe. We're currently absorbing the notion of rates remaining higher for longer, indicating that once the Federal Reserve concludes its tightening cycle, which is anticipated happening this year with the final 25 basis point hike, it intends to maintain interest rates at these elevated levels for an extended period of time, possibly well into 2024.
And the Fed signaled that they're nearly done at the September 20th meeting, and yet rates moved higher after that?
Yeah, one of your favorite market pundits, Jim Bianco, suggested that the bond market reacted negatively to the idea of just one more rate hike, perhaps because bond vigilantes did not believe inflation is contained. Bonds sold off at the end of the quarter and are now in negative territory for the year.
Great, thanks, Karen. Now let's talk about the Wespath funds. Starting with equities, can you give us a rundown for the quarter?
Yeah, you can see that the Wespath equity funds ended down for the quarter with both our U.S. and international equity fund composites down over 3% and 5% net of all fees. I'll review the specific contributors and detractors to our quarterly fund performance here in a moment. Although the quarter showed negative returns, the year-to-date performance of our equity funds has remained positive. The U.S. equity funds are now up 10% and 12% respectively, while our international equity fund has also managed to stay positive, returning 2% net of all fees.
So negative absolute performance in terms of equities for the quarter. And from your previous comments, fixed income was also down for that time period.
Yes, both were down on the quarter, with much of the bond losses coming in September. The fixed income fund composite fell 2% for the quarter. Year to date, despite the bond market being negative, the fixed income fund composite was positive and returned over 1%.
That's great that the fund returned a positive year while the rest of the bond market was negative for the same period. What do you attribute to the strong relative performance to this trailing time period?
The fixed income fund composite demonstrated remarkable resilience in the face of a challenging condition in the bond market. The composite is primarily actively managed, therefore the collective work of our active managers and their issue selection, along with navigating the yield curve and duration in this challenging environment, has benefited our investors. Also, the composite's overweight to high-yield bonds has been a strong contributor to the long-term performance.
All right, before we move on, any comments on the other bond fund, the Inflation Protection Fund?
Yes, a few updates. Similar to the fixed income fund composite, the Inflation Protection Fund was down 1.5% for the quarter and was positive year to date, despite the benchmark being down.
Thank you, Karen. So before you talk about specific contributors and detractors, let's get a sense of where we are compared to others in the industry. Can you tell us how the multiple asset fund composite compared relative to other balanced funds?
Yes, of course. This chart showcases the multiple asset fund composite versus a universe of balanced funds. This slide measures how our balanced fund performed relative to other balanced portfolios and funds that are currently on the market. Looking at the chart, you can see that the multiple asset fund composite has performed above The median across all time periods, with the exception of the 3-year, which was slightly below, as you can see from the chart. But the 10-year time horizon, the multiple asset fund outperformed 57% of its peers.
Great, thanks, Karen. Now let's get to the contributors and detractors for the fund's quarterly performance. Can you break down what helped and what hurt the funds in the third quarter?
On a gross of fees basis, the multiple asset fund underperformed by 66 basis points in the third quarter. No surprise that the positive contributors to the fund's relative performance was the outperformance by our 2 fixed income funds, which comprised 35% of the multiple asset fund. The primary detractor to the performance was the equity funds, which I'll talk about here in a moment.
Thank you. And fixed income funds experienced negative absolute performance. They outperformed on a relative basis. On the other hand, our equity funds faced a decline for the quarter and underperformed their benchmarks. So let's dig into that a little bit more.
Starting with the U.S. equity fund, this fund underperformed its benchmark by 17 basis points for the quarter. Strong stock selection by our active managers in energy and technology contributed positively to the performance. One strong position from an active manager was Guidewire, which is a software company that offers a platform for insurance providers. This stock was up 18% for the quarter due to a strong increase in sales. Also, energy companies that our asset managers invested in were a benefit. One example is Apache Corporation, which was up 21% for the quarter.
And what were some of the detractors for the U.S. equity fund?
The main detractor was the fund's overweight to small and mid-cap growth stocks and corresponding underweight to mega caps, specifically mega tech or the Magnificent Seven that has been highlighted so much these last few quarters. These companies are Tesla, NVIDIA, Facebook, Google, Microsoft, Amazon, and Apple.
And why have these mega cap names continued to do so well?
Well, for one, these mega tech names have actually been benefiting from rising interest rates. They are earning more in interest income than what they are paying in interest expenses. As I highlighted last quarter, we are invested in these names, but the weighting our fund has to these stocks is less than the benchmark. This is primarily where the mega cap stock underweight makes an impact. Some of these 7 stocks have returned almost 200% from NVIDIA and 150% from Meta, which is Facebook's parent company. These Magnificent Seven has contributed to 92% of the return in the S&P 500 so far this year.
You mentioned that the international equity fund underperformed its benchmark for the quarter. What were the drivers of the fund's relative performance?
The international equity fund underperformed by 240 basis points. The primary reason for the underperformance was stock selection by the fund's active managers, particularly in financials, information technology, and industrials. An example is a financial company called Adyen, which is an online financial tech company. This stock was down 57% during the quarter.
It sounds like active management played a big part in the fund's underperformance. Any other contributors you'd like to highlight before we move on?
Yes, the fund's allocation to private equity contributed positively to the performance.
Interesting, and thanks for highlighting that. Now let's talk about bonds and how the 2 fixed income funds performed on the quarter.
As I mentioned earlier, despite the bond market being down during the quarter, the fixed income fund outperformed by 52 basis points. We do not report on the fund's duration in the webinar, but the fixed income fund has a shorter duration than the benchmark, which helped us, and it's important to note that duration measures how sensitive our fund is to the rise in interest rates, which rising interest rates is negative for bond prices. So with this said, there was a meaningful rise in rates that happened during the quarter, and the fixed income fund was not as sensitive to that rise in rates due to our shorter duration. So the impact was not as meaningful to the fund's relative performance. Relative to the fund's benchmark, the fund is overweight high-yield bonds, which contributed positively as those bonds did well during the quarter. Also, high-yield bond manager issue selection contributed positively as the manager invests in higher quality, higher yielding bonds, which helped. Also, the emerging market debt managers issue selection, particularly in Latin America, contributed to the fund's performance. The final positive contributor was the fund's allocation to our internally managed positive social purpose lending program.
It looks like there's no detractors to report for the fund, so let's move on to the final fund, the Inflation Protection Fund.
The Inflation Protection Fund outperformed by 29 basis points for the quarter. The fund's allocation to floating rate senior loans helped as we saw rates rise during the quarter, and these loans are higher yielding, which also performed well. Also, the commodity managers issue selection helped as they were overweight energy. A detractor to the fund performance was its allocation to emerging and international developed market linked bonds. Emerging market and international developed market linkers underperformed U.S. Treasury inflation protection bonds in the third quarter. Also, these allocations are out of benchmark allocations. Therefore, the poor performance was a detractor to the relative performance.
Thank you for that performance summary, Karen. We appreciate you being here.
Thanks, Joe.
Dave, thanks for joining the quarterly webinar. Let's once again start with the state of the U.S. economy. I reported earlier that the U.S. economy likely grew at 5% in the third quarter. You've shown charts in prior webinars where economists forecasted a recession that would begin in the second half of this year. The question is, how did they get it so wrong?
Thanks, Joe. It's great to share my thoughts once again about the U.S. and world economies and markets. Indeed, U.S. economic strength has confounded the experts, demonstrating continued resilience in the face of the doom and gloom predicted by most economists at the beginning of the year. I'll start with the same slide with which I began our webinar 3 months ago, now updated with the latest data. On the left is the path of predictions from a panel of some 70 economists from Wall Street, academia, and various think tanks. Their initial optimism of 2.5% growth for the year faded as the Fed raised interest rates in response to generational high rates of inflation that we experienced in 2022. In January, they forecasted a flat economy for the year, with a majority predicting that we would be in the middle of a recession by now. However, economic growth modestly beat expectations in the first 2 quarters this year. And as you mentioned, Joe, if the Atlanta Federal Reserve's current third quarter forecast of 5% is even close to actual results, the economy will have produced a remarkable performance compared to expectations at the beginning of the year.
So why do you think the economy has performed so well? And what have been the drivers that proved the experts to be so wrong?
It definitely, Joe, has been the consumer. On this next chart, we see that consumer spending accounts for over 2/3 of the U.S. economy. The table on the left shows the contribution of each component to total GDP. The table on the right shows how these components are contributing to GDP growth. Estimates of inflation-adjusted consumer spending increases in the third quarter accounts for half of the Atlanta Fed's forecast. So I know, Joe, you have 2 teenage daughters, and did they by chance happen to see Taylor Swift when she was in Chicago this summer?
No, Dave, my daughters are not Swifties, and my bank accounts appreciates that fact because of the likely thousands of dollars that would have cost me if they were.
Well, the Federal Reserve actually credited Taylor Swift's tour with boosting the economy. Along with Beyonce's tour, the 2 performers generated billions and billions of economic stimulus in the third quarter. And we also continue to see significant tourism throughout the summer as well. Accordingly, it follows that business investment increased given the strong consumer spending patterns. The Atlanta Fed forecasts that business investment accounted for 1 percentage point of its forecast. Further, while the U.S. continues to have a balance of trade deficit, we've seen steady improvement in the deficit since the pandemic as U.S. exports relative to imports increased, and that accounted for another percentage point of GDP growth. If you're wondering, Joe, what are the major U.S. exports? Energy, aircraft, and autos comprise the top categories.
So, Dave, I would have never guessed that Taylor Swift would make such an economic impact. But let's look ahead to the fourth quarter and beyond. What are your thoughts of a recession in the near term?
Well, Joe, I'm worried about several economic headwinds. As you know, millions of Americans with student loan debt began repayments in this month in October. High mortgage interest rates mean that the housing market is going to struggle for quite some time. Gas prices have once again turned higher. Americans are depleting their savings account and incurring higher levels of credit card debt. We've several ongoing labor actions, notably in the automobile sector. And finally, dysfunction in Washington could mean a government shutdown in November, and we've also had these various geopolitical conflicts. The good news is that we continue to have a robust jobs environment. The Labor Department reported that the U.S. economy added the most jobs in September since January of this year. In addition, we've seen a pickup in the labor participation rate, meaning that more people are going back to work. Perhaps the benefit of full employment will outweigh all these headwinds. We'll certainly know, Joe, as we get closer to the holiday season as to how the fourth quarter is going to shape up as far as the economy is concerned.
So let's shift gears a bit now, Dave. When you listed the headwinds facing the U.S. economy going into the fourth quarter, you mentioned high mortgage rates. What are your thoughts about the future action by the Federal Reserve and the interest rate environment?
Well, Joe, I have no insight that would differ from the market's expectations regarding future Fed action. Consensus is that we will see one more quarter point increase in rates in November and possibly another rate increase in December, though comments from Fed governors this past week seem to indicate that they may not have any more cuts. It all depends on what we see in the data. I don't expect that we're going to see much higher rates in the short end of the curve. Interest rates for U.S. Treasury bills from 1 month to 1 year are currently in the 5.5% range, and I don't expect that to be any different going forward. But in absent of an unexpected spike in inflation, I think that short rates have likely peaked.
So then, Dave, you think that inflation is under control and is headed for the Fed's 2% target?
Under control, yes. Will it reach the Fed's 2% target? I'm afraid not so. 2% just seems unlikely in the near term. So let's look at the next chart. Indeed, the rate of inflation for the two largest components of CPI, shelter and food, are declining, though still meaningfully above the Fed's 2% target. Transportation inflation, though currently closer to the target, is more volatile as it is heavily influenced by the price of oil. As we can see on the right side of the chart, consumer expectations for inflation continue to decline, but are still in the 3% range. My view is that inflation will remain near 3% for the next year or so. Not high enough to force the Fed to continue raising rates, but not low enough for the Fed to begin lower rates, at least in a meaningful way. So, Joe, back to your earlier question about the interest rate environment. You may have heard the phrase higher for longer. Absent of severe recession and absent reaching the 2% inflation goal, I don't think we can count on lower interest rates anytime soon.
So you talked about Fed policy and near-term rates, but what about long-term interest rates? And we've seen a spike in long bond rates over the past month. Do you have any thoughts about the future direction of long-term rates?
I do, Joe, though I'm not sure you're going to be happy with my answer. Indeed, as we see in this next chart, rates for 30-year U.S. Treasury bonds are the highest they've been since 2007. Now, let's be clear. Federal Reserve policy certainly influences short-term interest rates, but what influences long-term interest rates is a completely different set of factors.
And what factors are those?
Simply, Joe, supply and demand. The federal government continues to incur massive amounts of debt, which leads to the U.S. Treasury issuing massive quantities of bonds. The Federal Reserve currently holds $8 trillion of U.S. Treasury securities. It is currently a seller of securities and not a buyer. Furthermore, U.S. Treasury securities are less attractive to foreign investors as foreign bond rates are now more competitive with U.S. rates. Earlier, Joe, you showed a chart forecasting that U.S. debt as a percentage of the U.S. economy is expected to rise to 118% in 2033 from 98% today. These next two charts provide additional perspective on the problem that you pointed out earlier. The first chart shows the magnitude of the U.S. government's deficit and surplus for the first 75 years of the 20th century. Except for spending during World War II, deficits were rather modest. The budget deficit was around $50 billion a year during that period, and then ballooned to nearly $80 billion in the mid-70s on the heels of what was called stagflation. That was when the U.S. economy experienced slow growth with a heavy bout of inflation. But now look at the extent to which the government has spent way beyond its revenues over the past 50 years, and especially the last few. The deficits we saw in the prior slide are barely noticeable on this graph. JP Morgan expects that the 2023 deficit will have been $1.7 trillion and that 2024 will be $1.9 trillion. The current level of spending is clearly unsustainable and will continue to expand the supply of U.S. Treasury securities to fund the deficit. I am concerned that demand cannot keep pace. If it doesn't, we are likely to see higher long-term rates for longer.
I see your point, Dave, but what does this mean for investors? Should they be considering making changes to their investment strategy?
It all depends on one's investment objectives. I don't see a reason for long-term investors to alter their investment strategy. Given the current interest rate environment and the likelihood that rates will remain higher for longer, investors can certainly expect better returns from bonds than we've seen over the past 3 years. For those with near-term objectives, they are probably best off moving funds to short-term fixed income investments if they haven't already done so.
So, Dave, what's the solution? What do you think Congress and the president need to do to control what appears to be runaway deficits?
It seems to me, Joe, that there are only 3 ways we can tackle the debt problem, and 2 of those ways are bad. The first is to cut spending, which is not popular or a likely solution. The second is to raise taxes, which is also unpopular, but less unpopular than cutting spending. The third solution is greater economic growth, which will generate more taxes without raising tax rates. This latter solution is certainly a win-win, but does not seem likely in the near term due to the several headwinds that I talked about earlier.
So you mentioned that bonds should generate reasonable returns from this point, Dave. But what about stocks? Aren't higher interest rates bad for stocks?
Yeah, Joe, generally higher interest rates are a negative for stocks, but not necessarily.
So why is that?
There are a couple of reasons why stocks can continue to generate reasonable returns in the 8 to 10% range for the next several years. First, growth in corporate earnings per share are set to rebound in the fourth quarter and beyond, as you can see on this next chart. We had a year where earnings hardly ever grew relative to prior year, but they're set to grow into the future. In addition, corporate share buyback activity, while not as robust as prior years, remain at a healthy level as we see in the next chart. I do believe that current stock prices anticipate a mild recession sometime over the next year, but should we experience a severe recession, then certainly stocks are going to suffer.
Understood. Before we end this session of the webinar, what would you like to say about economic conditions overseas?
Manufacturing conditions, especially in Europe, remain anemic, but services activity are positive. This next chart is the same heat map that we've shown before, illustrating overseas manufacturing activity, which in Europe and especially Germany is poor. Conditions in the emerging world are somewhat better and remain strong in India. Speaking of India, Joe, I've heard a lot of positive comments from various market strategists about India. The country has a strong demographic tailwind, an increasingly educated workforce, and a strong entrepreneurial spirit. Expectations are high for India. This next chart looks at services activity, which, while weakening, remains mostly in positive territory. So overall, Joe, I would say the outlook for near-term international economic growth overseas might be labeled as cautious optimism. Inflation, as in the U.S., is declining. Interest rates are up, though fiscal conditions seem well controlled. Geopolitical issues in Ukraine, China, and now the Middle East are certainly a cause for concern. But similar to the U.S., we're in a wait-and-see mode for now.
Well, Dave, thank you for your interesting observations and for joining us today.
Thanks, Joe. I've once again enjoyed sharing my thoughts with our viewers.
With me today is Sylvia Poniecki, Director of Impact Investments at Wespath. One of the primary strategies that Sylvia is responsible for is managing our Positive Social Purpose, or PSP, lending program, which invests primarily in loans that support affordable housing and community development for underserved areas across the United States. Sylvia, can you give us an update on PSP activity this year?
Happy to do that, Joe. PSP activity for this year so far totals $18.5 million. This consists of forward commitment executions totaling just under $4 million and loan participation purchases totaling $14.6 million. We've also had $21.5 million in loan payoffs through the third quarter of this year. We are continuing to see prepayment activity, but it has slowed down a bit compared to past years, given the current interest rate environment. And at the same time, we do expect to see some burn-off in the portfolio, given the age of some of the loans and amid interest from those looking to refinance properties and extend affordability on those loans.
And how is the existing PSP portfolio doing overall?
Overall, the PSP portfolio has remained stable this year, with only about 9% of the total loan balance currently on our watch list. And this continues to be low in comparison to previous years. Some of that is due to watch list loans paying off, but the other big driver here is that the majority of existing affordable projects are seeing high occupancies and stable cash flows. The high demand for and overall shortage of affordable housing units across the U.S. results in strong operational performance for existing properties, and thus not having many deals on the watch list currently.
That's great. Can you give us an example of a recent project that Wespath has invested in through the PSP lending program?
Sure. The project I wanted to highlight today is Rosemary's Way Apartments. This is a mixed-unit income development in Concord, New Hampshire, which contains 42 rental units, 31 of which have restricted rents and 11 are market rate. The project includes a variety of in-unit and common area amenities for residents, and 4 units in the development are reserved for individuals suffering from mental illness, with additional rental subsidies and services assisting tenants in those units.
And then taking a broader industry look, what are some of the challenges you're currently seeing in the affordable housing space? Interest rates have obviously been a factor, but what else?
So for those that watched our webinar from the first quarter of this year, my colleague Trent Sparrow mentioned a few challenges facing the industry, including high interest rates, rising construction costs, and limited financing resources. Those certainly continue to impact pipelines and development activity, but in addition to that, escalating operating costs are really putting pressure on new housing transactions as well as existing properties. One of the primary drivers for cost increases in recent years has been property insurance. And we recently put out a blog discussing how climate and extreme weather events are some of the big factors that are causing spikes in insurance premiums. So for example, over the past year, insurance premiums on multifamily properties in the US increased by 26%. This is certainly affecting an already strained housing market that can't keep up with the demand to produce enough affordable housing units for low and moderate income households.
So it sounds like these cost increases could extremely impact the viability of these projects.
Absolutely. Constructing a project is only one step. Making sure that it underwrites and is feasible over a 15 or 20-year loan term is just as important. Affordable housing is more sensitive to rising costs because of the limited rents and cash flows on these projects. So any significant or unexpected costs, such as insurance doubling or tripling, in a short time period can significantly affect the loan that was previously a solid performer. And for new transactions, if costs continue to spike and budgets get out of hand, deals in the pipeline may not pencil out and never get built, thus adding to the already existing affordable housing shortage.
So what are some of the things that you and the team are doing to manage the situation and its impact on existing and future deals?
I say this often, communication and reporting are key. We remain diligent with our intermediary partners on the assumptions that they are applying to deals in their pipelines. And we are also monitoring the existing portfolio and discussing with them ways to mitigate any potential issues. And then, things are relatively stable currently. We hope that they remain that way, but we want to make sure that we have a plan in place to address any problems that may arise.
Sylvia, I appreciate you joining me and talking about our PSP program and providing some current insights on the affordable housing industry.
Thanks for letting me join and share, Joe.
That's all I have for today. Thanks for joining.